Can you really build wealth by investing just a tenner a day? That's what I wanted to find out, so I ran a 60-day experiment. I invested £10 every single day into a trading 212 pie containing just two equities, the VWRP and the VUAG. I'll cover more what those mean later on, but that's what I did for 60 days, and this video is to discuss the results. That £600 invested over 2 months, tracked day by day. I'll walk you through the results, including updates at key milestones throughout the experiment and what I learned from doing it. First of all, what was in the Trading 212 pie? If you're unfamiliar with Trading 212, you can build pies which basically contain either individual stocks or funds of your choosing, and then you choose to invest in that pie, which automatically kind of distributes the money however you set it up. In this experiment, I've only obviously got two funds, and they were equally split with a 50-50 weighting, meaning for every £10 I put in per day, £5 was going to go into the VWRP and £5 was going to go into the VUAG. Now, the VWRP is the ticker code for Vanguard FTSE All-World ETF, the GBP accumulation version, meaning that any dividends paid out from any companies within that fund automatically get reinvested. The VWRP aims to track the FTSE All-World Index, which covers both developed and emerging markets. It holds around 3,700 companies from around 50 countries. The top regions covered are the US, which is at least a 60% weighting, in addition to Europe, Japan, and the emerging markets. Top sectors include technology, financials, healthcare, and consumer discretionary. The dividend style is accumulating, as I covered, where the dividends are automatically reinvested and not paid out to your account. The ongoing charge is 0.22%, which is the annual charge levied by Vanguard themselves. The appeal of this one is a one-stop global market tracker, which is a great diversification, as you'll see in the other fund that is heavily weighted towards a single country. Now, the VUAG is Vanguard's tracker for the S&P 500. The S&P 500 contains the largest 500 companies in the US. As you might have guessed, there are 500 companies in there covering about 80% of the US stock market. The top sectors include technology, healthcare, financials, and consumer discretionary. And the top companies at the time of doing this were Apple, Microsoft, Amazon, Nvidia, and Alphabet, which is Google. Dividend style for this one is also accumulating, as in they reinvest the dividends. The ongoing charge for this one is very low cost at 0.07%. And the appeal to this one is a pure USA exposure, which has historically strong performance driven by the big tech companies over in the States. The idea here was simple. Just use two popular funds, one global and one US focus, to see how consistent daily investing would perform over time. So day one, I made my first investment of £10, and obviously the current balance being just £10 and no chance for profit or loss just yet. Now, by the time we got to day 10, we'd invested £100 and we were actually down 44 pence. So our current balance is £99.56. This is completely expected. The markets go up and down all the time, and it was such a short period of time that we just continue investing through it. By day 20, we had £200 invested and were sat on a potential loss of £2.41. So our current balance was £197.59. Fast forward to day 30, and our current balance is £311.13, and so therefore have an unrealized gain of £11.13. Unrealized gains and losses are just the amount of money that you would gain or lose if you were to sell all of your investments at that point. 10 days further into the future, on day 40, we've invested £400 of our own money and we're sat on a balance of £415.40, meaning an unrealized gain of £15.40. As we continue to invest £10 per day, by the time we get to day 50, we're sat on a balance of £517.96, showing an unrealized gain of £17.96. As we draw the experiment to a close, we've invested £600 and are sitting on a balance of £620.27, giving us an unrealized gain of £20.27. So, what have I learned from that? It's a very, very short period of time, and when you're investing, you should be investing for 10, 15, 20 years, not just the 60-day period. But it was a very realistic experiment, and a lot of people could afford £300 per month, which is what the £10 a day obviously equates to. Now, you could actually swap that out and just do working days in a month, because the markets are actually closed on the weekends, which would get you to around £210, maybe £220 per month if you were just doing £10 on every working day. By using just the VWRP and the VUAG, I kept it super simple. I wasn't having to track individual stocks, finding out if their companies were doing anything that might affect their stock price or anything like that. It was very almost set and forget. And whilst I was documenting it on Instagram, YouTube Shorts, and TikTok, other than just getting that update and making another investment, I wasn't worried about what companies were contained within that ETF or what those individual companies were doing, because the funds were so diverse that it's just allows you to invest for a long period of time without having any of that headache. So why did I stop at 60 days? Well, I didn't actually stop investing, but what I did was move to kind of monthly investments. And so I moved all of those investments into my early retirement pie, which I also had on Trading 212. The point was never to invest forever and keep the series going forever. That would have got boring very quickly. But it was really to show that consistency over a period of time can give you some gains. Now, I could have quite easily seen a loss over those 60 days as well, in which case it wouldn't have really mattered because I've continued to invest anyway, but as part of the other pie. So that's my 60-day journey of £10 per day into VWRP and VUAG. My total investment was £600 and my final balance was £620.27. Would I recommend doing the same for anyone else? Yes, kind of. The one thing to bear in mind is the VWRP is actually made up around 60 to 70% of the S&P 500 already. So by taking the S&P 500 and VWRP into the same pie, you're actually doubling your exposure to the USA. So overall, the USA exposure is closer to 80%, whereas if you just went with VWRP, it would sit around 60-65% instead. If you are comfortable with that, then by all means do the same thing. This is not financial advice and you should do your own research before investing. If you enjoyed this breakdown, give the video a like, hit subscribe, and let me know in the comments what sort of investing you do or what sort of videos you'd like to see in the future. Happy to do investment challenges and stuff like that. I've got another one coming about how I invested £50 every single day into the almost daily dividends pie, and I did that for 35 days. Thanks for watching. I'll see you in the next one.